Good morning, everyone. So let's discuss second problem from business combination chapter. So what is the question about? So Plantation Homes Company is considering the acquisition of condominiums incorporation in early 2008. So in the year 2008, they are going to acquire this company. Then to assess the amount it might willing to pay, that means how much money you have to pay. You are willingly to pay because you want to buy another company. So the Plantation Homes makes the following assumptions. So here again, this is the subsidiary company, the parent company. Okay, so Plantation Home is the parent company. And we find that the condominiums is the subsidiary company. Now, if you want to buy a new company, okay, so you have to pay money, right? So you have to figure out how much you have to pay. What is the price you should pay to buy this company? And you have the following assumptions. So the condominiums incorporation has identifiable assets with a fair value of $15 million. Okay, so this is the fair value. This is the fair value of their asset. And this is the fair value of their liability. So this is important. Why this is important? Because you have to calculate the net asset, right? You have to calculate the net asset. So when we plan to pay, okay, what should be the amount? So we are looking for this amount. We are looking for this amount. So here you have to remember that we are considering. So what should be the price? It is the net asset plus, that means we have to pay net asset plus we have to pay the estimated goodwill. So this is the things we are going to calculate actually. What should be the net asset? So according to this question, net asset is already here. This is the fair market value of the asset. This is the fair market value of liability. So asset minus liability is the net asset, right? Then we have to calculate the estimated goodwill by using another information. The assets include office equipment with a fair value approximating book value. Okay, so what is the meaning? So find that we have one asset called equipment, and the equipment information is here. Fair market value equal book value. If this is the case, okay, if this is the case, then we no need any adjustment. We no need any adjustments. Why we no need any adjustment? Because the fair market value and book value are the similar, right? So no need any adjustments. No need any adjustment. Then what about the building? Building with a fair value 30% higher than the book value. Okay, so building, we have another asset building. And according to this question, so fair market value is higher, is greater than the book value. That means need adjustment. we need adjustments. Why we need adjustments? Because fair market value is higher. If fair market value is higher or fair market value is lower, we need some adjustment. Clear? Then land is another asset. Land is another asset. And what is the information about land? Fair market value is 75% higher than the book value. Again, we find that this is the information. Now, my question is here. Do we need any adjustment? Do we need any adjustment? This asset is land. Okay. Asset is land, and the fair market value, okay, is 75% higher than the book value. So do we need any adjustment or not? Because building, you can see that building do not have any change, right? Sorry, equipment do not have any change. So no adjustment. Building fair market value increase. If building fair market value increase, it means that the depreciation expense will increase, right? Fair market value of your asset increase, building, right? This is the building. Building value increase, it means that depreciation on building will increase, right? And if depreciation of building increase in future, then what about your net income? Net income will increase or decrease? Net income will decrease, right? But here land value increase, but we know that land do not have any depreciation, right? Land do not have any depreciation. So land do not have any depreciation. So land value increase or decrease, it doesn't matter. Why it doesn't matter? It will not hit any part of your income statement. Okay, so no need adjustments. Do you understand? I repeat again, equipment, fair value, and the market price similar. So no need any adjustment. What about building? Building fair value increase, right? Or building fair value decrease. Anyway, building have depreciation, right? Building have the depreciation. So if fair market value increase, it means that depreciation expense will increase. And depreciation expense will increase means your net income will decrease, right? Vice versa. If fair market value decrease, then depreciation expense decrease, net income will increase. However, in case of land, although land fair value increase, but it is not going to hit our income statement. Why? Because land do not have any depreciation. So land do not have any depreciation, whether land value increase or decrease, it is not going to hit our depreciation expense. So it is not going to hit our income statement also. Clear? Then this is the first assumption. Let's move on the second assumption. So condominiums incorporation pre-tax income. So pre-tax incomes. Incomes means here we have several incomes. So their last 3 years income are given, 2005, 2006, and 2007. So 3 years income are given, and it is 1.2 million, 1.5 million, and 9.5 million respectively. So 3 years income already given, right? But we are going to calculate income for 2008. Do you understand? 267 given, sorry, 567 given. So we have to calculate what should be the expected income for year 2008. Because why 2008? Because we are going to buy this company in the year 2008. Now, Plantation Homes believes that an average of 3 years earnings represents the fair value estimate of annual earnings of the indefinite future period. Anyway, so they say that this kind of average earnings, okay, that will help you to calculate the expected earnings, and you are going to have this kind of expected earnings for indefinite future. So I told you that if you have this keyword, we have one way to solve it, right? If we have another information like a specific year, then we have to discount it. So we have two methods for this. Do you understand? So this company believes that the average earnings will help you to estimate the future earnings, and it will exist for indefinite period of time. Anyway, so you can see here, you can see that depreciation on building. So here, this is the depreciation on building. Fair market value is higher. Okay, so where is the depreciation on building? This one. So fair market value is higher. Here, building. Depreciation on building, fair market value is higher. So it means that so $960,000 times 30%. 30%. So it means that it is $280,000, 288. $288. So this $288,000 is going to increase. So depreciation expense $288,000 is going to increase, right? Why it is going to increase? Because fair market value is increase. Fair market value is increase, so depreciation expense will increase. And we know that if depreciation expense increase, what about the net income? Net income decrease, right? Net income decrease. Net income will decrease. So net income will decrease. Net income will decrease. So in future, you will have $288,000. Okay. So this is anyway. So you understand. So depreciation expense $288,000 increase means net income will decrease in future, right? Now building equipment. Equipment said that fair value and market value are equal. So no change. So this part no change, no effect. No effect. What about extraordinary loss? You know that extraordinary loss means it is one time event. That means this loss will never happen in future again, right? This loss will never happen in future. This is called extraordinary loss. So if this loss will never happen in future, okay, what do you think? How it will affect your net income? Future net income. What should be the future net income? So this loss will never be happen again, right? So 2008, you will not have this loss. So what do you think? Your net income will increase or decrease in future? Increase, right? Yes. So your net income will increase. Net income will increase because this loss will never be happen. If extraordinary gain, that means again this gain is called one-time event. So this gain is called the one-time event. What is the meaning? Meaning is this gain will never happen in future, right? This gain will never happen in future. So this gain, this year, this gain increase your net income. But if you in future you do not have any gain, your net income will decrease. Clear? In future, you will not have this gain again. So if you do not have this gain again in the future, that means your net income is going to decrease. So these two items important. You have to remember these two items. This is called extraordinary loss and extraordinary gain. It is one-time event. It will not happen in future. So gain will never happen again. So your net income will decrease, and this loss will never happen again. So your net income will increase. No, sales commission do not have any information. So sales commission is not extraordinary gain or loss. It is regular, right? It is a continuous operation. It is a continuous operation. You will have sales commission, salaries, expense, interest expense, advertising expense every year. It is regular income and expense, something like this. So this is about assumption 1 and assumption 2. And we have return on asset 15% given. Return on asset 15% given. And assume that this plantation homes feels that it must earn 25% return, 20% return in investment. So if they do not buy this company, they can invest this money to a bank or any other capital market, and they may earn 25%. They may earn 25%. And this kind of expected earnings will last indefinite period of time. And based on this assumption, calculate the reasonable offering price. Reasonable offering price and ignore the income tax effect. So again, so if we want to calculate the price, this is the formula. So net asset already given in the question. Now, in order to calculate estimated goodwill, we have to go through 6 steps. Okay, so that means this part, to calculate the estimated goodwill, we have 6 steps to go and find this information. Step 1 said that identify the normal rate of return, right? Normal rate of return. We know this information, and it is 15%. So this is given in the question, no problem. This is given. Then step 2, apply this 15% return to the net asset. Okay, so we are going to multiply 15% with our net asset to get the normal earnings. Okay, so normal earnings. We need normal earnings. We need this information. And to do so, they said that we have to apply our rate of return to our net asset. So net asset is given here. This is the fair market value of our asset. So fair market value of assets is given. Then fair market value of liability also given. And it is 6.2. So this is the net asset. So we calculate the net asset, $6.2 million. So and they said that apply the rate of return. So ROA is 15%. And the formula is this. So this is the normal earnings. We find the step 2. Then we are going to calculate expected future earnings. I told you that this is the difficult part. But if you understand this kind of assumptions, okay, assumption 1 and assumption 2, then it is quite easy for you to solve this. So according to this question, the question 1, we had only 1 year pre-tax income, right? Now question 2, we have 3 years pre-tax income. So we have to consider this 3 years pre-tax income, make it average, and calculate for coming years expected income. So pre-tax income for year one here is 2,205. This is pre-tax income. Then we have pre-tax income 2006. And pre-tax income 2007. Okay, so previous question we had only 1 year pre-tax income. Now we have 3 years, and this is given in the question. 1.2 million then this is 1.5 million, 1.2, 1.5, and 950, 9.5. This is the pre-tax income. Now we need to do some adjustment, right? I told you that we need some adjustment. So first assumption said that here we already know where we need adjustment, where we don't need adjustment. We find that only building need adjustment, right? Only building needs adjustment. Clear? And how did the adjustment here? $288,000. $288,000 fair market value increase, right? That means building fair market value increase means depreciation expense increase. Depreciation increase means our net income is going to decrease, right? Yes, so this is the net income, you know that. This is the pre-tax income, right? Pre-tax income. So this I put here, and here. So this money, depreciation expense increase means this is going, net income is going to decrease. Do you understand why I deduct this money? So it is additional depreciation expense on building. This is the additional depreciation expense on building. So this additional expense will decrease your net income. Do you have any question here? So depreciation fair market value of building increase means depreciation expense will increase, and depreciation expense increase means net income is going to decrease. Very clear equation. Okay. So we find that land, we no need to do any adjustment, and equipment, we also no need to do any adjustment. Now, according to this second assumption, we find that we have, so we don't have this at this moment. We have extraordinary loss. We have extraordinary loss, but which year? Extraordinary loss which year? We have 3 years, right? 6, 7, 5, 6, 7. But we have extraordinary. I told you that it is one-time event, right? So it will happen only one time, not every year. So it happened in 2007, right? It happened in 2007. So this loss will never happen again, right? It means that we'll have more income in future. So 2007, what is 2007? This is 2007. So this amount is going to add it back. Extraordinary loss. Extraordinary loss. So we don't have any other extraordinary gain. We don't have any other discontinuous operation. Nothing is there, right? Sales commission we are not going to consider. Why? Because these are the regular items. So we don't need to consider this. Now we can calculate the amount. It is 912,000. And here it is 121,000. And this is 962,000. So 2005, 2006, and 2007. 2006, how much? 1212, right? Here. 121. Something like this. 1210. Okay, 1210, right? 00. Okay. Okay, so if we add this three, it is something like 308,000. 308, something like this. So this is called 3 years. 3 years total. Is the 3 years total. You find this amount. Now, what should we have to do? We have to calculate the average. Any mistake? This number is wrong. So this is the 3 years total, right? Then we have to calculate. We have to calculate the average. And it is so this is the average. And this is the expected earnings actually. I'm checking. This number, right? Okay, I'm checking. So 9/1/2000, okay. One two one two. I think this is okay, right? So previously I also write this. Then $3086. So what was the problem? I don't know. Yes, this is okay. This is the expected earnings, right? Because we make it average. So this is for 3 years earning, right? This is 3 years earnings altogether, and we calculate the average because we are going to calculate only 1 year expected earnings, right? So we make it average. Now our expected earnings. Our expected earnings is this amount. And we know our normal earnings. Our normal earnings is this one. And this is called excess. And the excess earnings here is 98,667. So this is the excess earnings. So we know our normal earnings. We know our normal earnings. We know our expected earnings. And normal expected minus normal equal the excess earnings. So this is the excess amount, means this is the amount we are going to use to calculate our goodwill. Okay, so goodwill is computed from the excess earnings. Now question said that it is indefinite period of time. You know that the question said that this expected earnings or excess earnings is going to last for indefinite period of time. So the excess earnings divided by what is our investment rate, market rate, 15%. So this is called estimated goodwill. So this is called estimated goodwill. So again, if you remember the formula, So this is the formula here. Now we know our net asset. This is the net asset. And we know our estimated goodwill. Equal, this is the price we have to pay if we buy this company. So this is the price of the company. So if you want to buy this company, you have to pay this price. Now, requirement B. Okay, requirement B said that assume that the plantation homes feels that it must earn 15% return on investment. Before it was 25%, right? They said that they expect the return would be 25%, but they changed their mind. They said that maybe not 25%, it may be 15%. But the average excess earnings are to be capitalized for 3 years. So they become more conservative. They said that no, it is not 25%, and it will not last for indefinite period of time. Okay, they become more conservative. They said that not 15, 25, it is only 15, and our expected earning will last only 3 years, not indefinite period of time. Okay, not indefinite period of time. So in that case, so this is our excess earnings. We have another formula. Times, that means main formula is here, okay, times present value of ordinary annuity factor. So you have to use the table to find a factor, and the factor should be 3 years, 15%. 3 years and 15%. So we have to use our table to find the factor, and the factor may be 2.28323. So this is the factor. Now estimated goodwill. Estimated goodwill now 225 279. This is the new estimated goodwill. Is the new estimated goodwill. So the new price is here, because net asset we have similar. Now it is 6425 279. Okay, so you have to read the question carefully whether you have alternative A or alternative B. Here, the expected earnings will last only 3 years, but previous question said that expected earnings will last for indefinite period of time. So you have different formula to calculate this. Okay, so let's review problem 3. So large corporation is considering a merger with local company and one of its suppliers. So local company is one of their suppliers. So they wanted to buy them. And in order to determine the fair offering price, large corporation has accumulated the following information. So in order to calculate the price, they're considering this kind of information. This is the book value of asset, and this is the market price of the asset. And this is the book value of liability, and this is the market price of the liability. Okay. And based on this information, we can calculate net asset. Okay, here is $150,000. So we already know our net asset. Now we have to calculate the estimated goodwill, right? We have to calculate the estimated goodwill. So what are the information? In the last 5 years, look, last 5 years, that means on average 5 years, income is given $100,000, right? This is 5 years average, right? So in total, 5 years, we have $100,000. So finally, we have to convert it on average for 1 year. Like previous question, we had 3 years. Previous question, you can see that we have, this is year 1, this is year 2, and this is year 3, right? Then this is a total 3 years. And from this total 3 years, we calculate average. On average, what should be the coming year expected earnings? The same, this question said that their 5 years total income is $100,000. So we have to make it average. Then normal earnings for the similar firms during the past 5 years are average 10% ROA. ROA is given 10%. And the large corporation want to have a minimum rate of 12%. So this is their market investment rate, and they are going to capitalize this earnings for 5 years only, right? So we know their total 5 years income, we know their return on asset, we know their investment rate, market rate, and we know that they are going to capitalize their expected earnings only for 5 years. Now, how much you have to pay? So this is the way to go. We know that return on asset is given. Return on asset 10% is given. Then we have to apply this rate of return to calculate our normal earnings. So we also calculate our net asset. So here I already show you how to calculate this. Net asset is $150,000. This is the net asset, 150. ROA 10%. And we have normal earnings, $15,000. So we know normal earnings. Now we have to calculate the expected earnings. Here we have only one adjustment. That means we don't have any asset, fair market value, and book value increase or decrease. We don't have this kind of information here. We don't have any extraordinary gain, extraordinary loss. We don't have anything. So we are going to convert. We are going to convert 5 year earnings into 1 year average. So now expected earnings expected earnings $20,000, and normal earnings is $15,000. Now excess earnings is 5,000. So excess earnings is 5,000. Now the question said that this 5,000 excess earning will last for 3 years. Oh, sorry, 5 years. 5 years only. 5 years only. So we know our excess earnings times factor, and we use present value ordinary annuity table. Present value ordinary table to find this number, and the estimated goodwill this. Now estimated goodwill plus net asset. Net assets plus estimated goodwill. So our net asset is $150,000, and estimated goodwill is calculated, and this is the price.